So I am very excited to get this started. If you've already watched some of the other videos, I have finally got the audio working correctly. So I will probably end up re-recording stuff. We'll see. But what I wanted to do was start from the very beginning. This is for anybody who would like to learn more about the markets, specifically futures, and really doesn't have any idea where to start. They have seen a chart, they kind of understand what things are from this very high altitude view of things, but they just want somebody to lay it out for them so they can start learning. That's what I am here to do. I'm here to try to make things as easy as I can for you and to teach you what I can. Am I the end all be all expert? No, of course not. I've been doing this for about a year now. I have made a lot of mistakes and I've learned a lot of stuff. So hang out. We're going to talk about what this market from first principles means, why I set it up this way, and my philosophy behind things. So I think what we can do is we can just start right there with the first principles idea. That is something that I believe in very strongly. So it was it Aristotle? I think it was Aristotle, like 530 BC, came up with this idea of going to the most absolute basic foundational level of something and then building back up from there. Everybody uses analogies for things. Trading uses analogies. I'm going to use a ton of analogies. That's a shortcut. And if you just go with an analogy and you move on, then you don't really understand exactly what's going on. You don't understand the why behind things. It's kind of a monkey see, monkey do thing. So what I want to try to do is help you get to that foundational level where you cannot break it down any further. There is no truer thing beneath where you're at. That is your first principle. So if you've ever been around kids, you are probably familiar with this. It's the why. It's annoying as shit. But the principle is sound. I want to know more. I want to know more. I want to know more. And it's this breaking down to try to understand this something fundamentally. So anyway, many years later, in the 1600s, there was this, was he a physicist? Anyway, there's this French guy who was very big on aggressively, what's the term? How'd I say this? Let me think about it. Give me a second here. I wrote some stuff down because I knew I was going to do this and I was going to forget. So, stand by. Cool. So it was Aristotle. It was about 350 BC. It was the first basis from which a thing is known. It's foundational truth of something. So that is where that chain of the why bottoms out, because you get to a point where you literally cannot go any further. And then we build everything on top of that. And then this guy, I think it was Rene Descartes, turned that idea into a methodology in the 1600s. And his whole thing was like radical doubt. So throw out everything you could possibly doubt. And whatever thing is still standing, the thing that you cannot doubt, that's your foundation. And then you just rebuild your knowledge on that, because you know there's nothing left that you can doubt there. It's just what it is. So, and then we move forward. We move into, the last 50 years. Well, something like that. 50, 60 years. Science and engineering really starts to adopt these same stances, right? So it's reason from the fundamental understanding of things, the fundamental laws of the universe, and not just what people have done before, right? So this was started out as like a thing in theoretical physics. This is something Richard Feynman, like brought back up the 1600s methodology, and they call it from first principles, or in Latin, it's ab initio, I think. Anyway, so Feynman was really pushing for the understand the fundamentals. Don't just memorize stuff. Don't rely on the analogies. Rely on your inherent of your knowledge that you have worked through, and it's been used since then. And then Musk kind of revived it recently ish when he's like turned it into a buzzword again, right? So the example was it was like he was looking at the cost of batteries, and he was like, no, I'm just not going to accept that it just costs $600 a kilowatt hour or whatever, because that's just what it costs. Like, what does it actually cost? He did the same thing with his rockets too, by the way. He like took what it took to build a rocket or a battery, and he broke it down to its raw materials and then rebuilt it from scratch. So like with his rockets, do the same thing where he's like, dude, for when you actually take a rocket apart and you take all of the things, all of the matter that goes into creating a rocket to shoot up into space, that's like 2%, 2 to 5% of what a rocket costs. So why are we spending all this extra money? Because he went down to these bedrock, undeniable things. So yeah, that's really the background for this. It's not just relying on analogies. That being said, let's move forward. So if you've ever opened a chart, or if you've ever seen one on TV or anything like that, and you're like, dude, I don't know what this means. This is very confusing. This is all gibberish. Or if you've heard, me talk about it, or you just on your own heard somebody talk about the futures market, and it just sounds like rocket science to you, or if you just felt too overwhelmed, like you want to start, and that's why you're here, but you feel like it's just been too much to tackle, this is where you should be. This is where you should start. We'll get through this stuff, and then we'll get into the meat and the potatoes of trading. Most people are going to quit. When you read the statistic that 99% of traders fail to be profitable, like that's a legit, honest assessment of things. I will say that being 1 out of 100 ain't that hard. Being 1 out of 1,000 isn't that hard. I mean, fucking 1 out of a million, you think about how many people are on Earth, it's not that hard. So why do people quit? You hear about the markets, you are interested for whatever reason that you were drawn to trading. So you're like, all right, cool, I got to figure this shit out. So you hop online, you find some YouTube guru or some expert or something, and then it's just they're speaking nonsense, right? So they're like, yeah, so if you look right here, you can see the FVG formed after the MSS swept the PD array, and it's all very simple. It's right there. You're like, dude, what? What was all that? Like, what the fuck's an FVG? So like, well, all right. So you pause the video and you go over here and you're like, all right, well, let me look that up. And you're like, fuck's fair value gap? Okay, well, now there's this like series of candles that I have to pay attention to. And like, if it does that, then it's probably going to do this, but it doesn't in this situation. And like, okay, well, now I have a bunch of other terms I don't understand. So start Googling those, and you're looking it up, and then hours or days or weeks or whatever later, you've followed all of these game trails around. And you're like, fuck, I feel like I know less than I did when I started. And you're like, you know what? This isn't for me. I'm going to go sell pictures of my butthole on the internet or whatever. And you walk away from it and you leave feeling dumb. And it's frustrating. And you say, you know what? That was not for me. And this happens all the time because you have really smart people, you, me, everybody else out there that is interested in this kind of stuff, that gets kind of run off, and it's not your fault. It's a vocabulary thing. It's a language thing. It's that whole forgetting how hard it was when you started, right? So I think trading, everything does, but I think trading is also really struggles with the language. So you have to learn a new language in a way to be able to understand what's going on, right? But not only do you have to learn this new language, you have to learn the local dialect for the type of trading that you're doing. So if somebody trades stocks and somebody trades crypto and somebody trades futures, we can all kind of generally understand each other with like broad strokes. But if somebody really starts talking about their calls and puts or whatever. Like, I don't know anything about how to actually do stock trading because I don't do it. I understand what it is, but they're going to use terminology that it doesn't make sense to me, or I don't know really what they're talking about because it's a little bit different. And same the other way, right? If I'm just talking about my stuff that I'm comfortable with and I talk about all the time to somebody who doesn't speak my dialect, same deal, right? So that in itself is hard when you already kind of speak the language. So the other thing is think of something that you are exceptional at. Everybody has something. And I don't know if you can think about a time that you were trying to explain it to somebody else and you just kind of couldn't. As an example, I have a buddy who is like one of the most phenomenal horsemen I've ever come across. And several years ago when I moved up here, I would go to his facility like every day and I would work horses with him every day. And we would go to like events together and I would assist in his clinics with him. So like I wasn't a novice, but then I watched this guy who's been doing this every day for his, since he was a little kid, and he would do something like, God, how the hell did you do that? And I don't know. You just do it. He was so far beyond those early stages that he just couldn't even figure out how to explain it to somebody. That's a shitty place to be when you're trying to learn, right? So just remember that too. You were there at one point before you became really good at the thing you're good at. This is just another one of those things. Be easy on yourself. Be nice to yourself. What am I going to do? What am I not going to do? I'm going to explain to you what a market is. I'm going to explain to you what futures specifically are, the futures market. I'm going to teach you how to start reading a chart. I'm going to walk you through what a candle is. And we'll give you some basic vocabulary. And then through that, you'll kind of get an idea of what the day-to-day trading looks like. We're not going to go too far into that. I will not be teaching you a strategy. That's me just saying, do what I do. I'm not going to make you profitable. I can't guarantee that. I can't promise that. That's a you thing. I can try to help you, but I'm also not going to give you setups to trade, which is another one of those analogy things, or just hand it to you. One thing I hear all the time, I can probably count on one hand the times people have not said this to me when this conversation comes up of like, I can help you learn this stuff, is, well, why don't I just give you money and you trade for me? First of all, don't be lazy. You know what I mean? Like, second of all, no. And I'm not going to, there are plenty of people that'll do it. I'm not going to take your money to tell you what to trade, because that is just you doing what I'm saying. That is just you copying with no understanding. That's not what this is about. This is about you getting to a point where you understand you got to put some fucking work in, but then you'll actually know. And by the time you get through this course, by the time you get through the first couple of modules, you're going to know more about the way markets work than 95%, 99% of people out there. Just telling you. I'm not going to go over advanced stuff with you, and I'm not going to recommend indicators. That is the realm of taking somebody else's analogy and just bolting it to your charts. And an indicator works great until it doesn't, because you don't actually know what it's doing. You don't actually know what it's looking at. You're just like, oh, it says to buy now, so I'm just going to buy now. I don't like that. Eventually, yeah, use indicators, but I would still try to have them be very lightweight. And I only use a handful. Half of them I've written, like I coded. So I know exactly what they do. And again, it's really more than anything, it just keeps me from having to do manual shit. But I make all of my own decisions off of market data. Anyway, and I'm not going to rush you. We are going to go at your pace. I mean, that's up to you ultimately, but I really am going to beat stuff to death. I'm going to repeat a lot of things. I'm going to keep using the same kind of concepts because we need to hear things over and over and over, especially when it's something that's like as much of a cognitive load as this. So let's get into what a market is. And I'm going to go as simple as I can. Please understand, I will use analogies. Yes, I try to focus on the principles first. methodology, but by the nature of having to explain stuff, there are going to be some analogies, but I don't stop at the analogy. We'll dig deeper. So be nice to me as I try to like make that both those things happen. So what's a market? The simplest thing, if you really just kind of break it down to something we can have a conversation about, it's just anywhere that people buy and sell shit. That's it. That's the whole thing. You go to the farmer's market, that is a market. You go on Craigslist to buy pictures of my butthole if this doesn't work. Like, that's a market. eBay's a market. The stock market's a market. The futures market is a market. It's just the same thing, right? It's just people want to buy stuff, people want to sell stuff. They agree on the price, and then the trade happens. The mechanics are all there. They're all just repeated over and over. The things that change is just context, right? So what's being traded? Who's allowed to participate, and how long does that take? So what's being traded? Well, what's the thing you're interested in? Like, are you looking at quilts? Are you looking at, fly fishing equipment? And then are you allowed to be in that trade? Does it make sense for you to be in that environment, in that market? You're not going to have Mima who is going to, who fits in at like the yarn place in a trap house trying to turn a profit on, bricks of cocaine or whatever. So it's where can you fit in? And then the time frame. Are we scalping crypto where we're trading in seconds to minutes? Are we trading in, stocks where you tend to hold it longer? So anyway, I'll stop talking about my butthole for a minute. It'll probably come back up. Stocks, futures, everything else. So there's these different markets that we can participate in, depending on like what we're looking for, what we are willing to invest in, startup capital, all that stuff. So if you get into stocks, a stock is just a tiny part of a company. So, or a share anyway. So you buy your share of Apple, you own a piece of Apple. If Apple does well and they make money, your stock increases and you make money when you sell that stock. If they're losing money, the stock price goes down. Your shares are worth less, and you essentially lose money if you sell when it's low. That's how stocks work. You really don't make money on the way down. Like if you're losing money, you don't really make money. It kind of has to go up for you to make money. There's like 3 things that I really love about futures, and that's why I trade them. Futures, fundamentally, is just an agreement on what price is going to be somewhere down the line, and we're agreeing to a price now. So you can make money up or down. If you're correct in what you think is going to happen and you put money behind that, you buy a couple of futures contracts, you think price is going to go up and it goes up, you make money. If you think price is going to go down and it goes down, you make money. And then the third thing I really like about it compared to something like crypto is your cash works both ways. But if I want to buy and sell, say, Ethereum or crypto, or Bitcoin or, Ravencoin or whatever, I need to have like liquid capital. I need to have cash in an account so that when I want to buy the Ethereum, then I can shell out my cash and I can grab some Ethereum at whatever price it's trading at that time. If I want to make cash, I have to sell Ethereum. So that means I have to have a pool of Ethereum to sell off at whatever price for the cash. So you have to maintain 2 different stores of wealth, I guess, and to go back and forth. Again, futures, you're just using cash both ways. So you don't have to worry about that. And then you've got all the other stuff. You got options, bonds, crypto, Forex. You can trade all that stuff, oil, right? Like even within the futures market, there's a lot of other stuff you can trade. Each one of these things is going to have its own personalities. And then even within like the futures contracts, each one of those different things that I'll show you kind of the main ones, those are also going to have their own personalities. So find the thing that you like to trade and learn it. Anyway, but we're talking about futures. That's what I'm into. That's what I trade. That's what I want to teach you. And then I guess the 4th thing, did I already come up with 3 things or was it 2? And I thought it was 3, whatever. The thing that I love the most about futures is it's not like the stock market where your starting portfolio has to have like a $250,000 in it or something. I think it's like $250,000 to open and trade stocks. I don't know anybody that's doing that. Futures, you have your regular futures market, and then you have your micros. So they're E-mini, whatever. Those are trading at 1/10 the price of the regular futures market. So that's where you can learn. That's where you can make mistakes without losing your shirt and get the repetition. So what is a future? When we say, oh yeah, we trade futures, what the hell is that? It's really not that technical. It's just a contract. It's a contract for something to be delivered on a future date. Super easy, not technical at all. It's just a contract. So a future or a futures contract or contract, it's literally what it sounds like. It is an agreement between two people about a thing. So one person saying, okay, I'm going to buy this thing at this price on this date. And the other person's like, cool, I'm going to sell you that thing at that price at that date. That's it. That's futures. That's markets. That's any markets or any market. The word future just comes from the fact that it's going to be, we're agreeing now to something later. That's all that is. So like super not technical, right? So this is an analogy that we're going to break down. Actually, this is like this is actually exactly why the futures market exists and why we can make money off of it. It's this scenario. This is the classic. If you haven't heard it before, you're going to hear it now and you'll probably hear it again. So this isn't mine. This is how I learned it. So imagine that you have a farmer who grows corn and you have a cereal company that makes cornflakes. The farmer is in kind of a weird spot, right? He or she doesn't know how much their corn will sell for come harvest, come 3 months after harvest, come 6 months after harvest, 9 months, the week before harvest, right? They don't know. Neither does the cereal company. So say we've got the farmer who's like, okay, cool. Here comes harvest season. I now have all of my corn to sell. But you know who else does? Every other farmer growing corn, right? Like they're all essentially harvesting at the same time. So you have a supply and demand issue now. You got the cereal company who needs their regular amount of corn, but now the market's been flooded with new corn. So maybe they're paying $2 a bushel. Maybe that's all corn's going for. That doesn't cover the costs of our farmer to even do that this year. So he's in a really tight spot. But he's smart and he, I don't know, maybe had a good yield this year or something, and he has excess that he is holding on to. So as the year goes on, eventually he's going to get to the point where there's no more corn out there. But he has squirreled away a good portion. So then 3 months before the next harvest comes, a cereal company still needs cereal to make their cornflakes, right? So now our farmer's like, I tell you what, I'm going to sell this to you for $10 a bushel. And the cereal company, they're like, okay, I guess we can't not have the corn. So supply and demand is flipped. Their budget's blown out of the water. They're losing money. They're laying people off. You know what I mean? So the shareholders are pissed. So you have two parties that are on opposite ends of things. You have the farmer who wants to know what he's going to sell it for. And he's going to want to be able to know how much he's going to sell it for throughout the year, right? And then you have the cereal company. They want to try to figure out how much they are going to spend to buy it throughout the year so that they can set their budgets. So instead of this, like, I'm going to get it cheap now, I'm going to have to pay out the ass later, they just come together and they say, look, dude, I'm going to try to pay you $2 a bushel now, at the beginning of the harvest, and you're going to try to get me to, $10 a bushel at the end of the year. So why don't we just agree with each other in a contract that we're just going to call it $5 a bushel every month. There's consistency there. Nobody gets screwed. Everybody sleeps easy. That is the whole thing. That's all this is. And you can do this with anything. Now, how do we make money? Do I have that on the next one? Yeah. Okay, cool. So we're not farmers. We're not making cereal. I don't want corn in my driveway. You know? So like, why are we involved in this? And we as like retail day traders, right? We just care about the price move. We're not actually taking receipt of any of this stuff. So if we're saying, okay, we agree corn's $5 a bushel today. And then next week, corn is $5.50 a bushel. And then we sell, we have just made 50 cents a bushel because we're getting we're pocketing the spread, right? So we never take the corn. Nobody's calling you being like, okay, I got 5,000 bushels of corn that I'm going to, like, I'm in your neighborhood. Which driveway do I drop this in? We just close it and pocket the difference before the contract like actually comes to, fruition or whatever, or, the date comes due. So basically it's just speculation on price movement. I think prices from here, I think it's going to go here. I think it's going to go here. We're never going to own that corn. We're just getting in and out through the price fluctuations up and down. You can do it on a 5-minute chart, on a 10-minute chart, on an hour chart, on a 4-hour chart, on a day chart, on a week chart. It's just what your comfort level is and what your margins are and stuff like that. So why are we doing micros? I already touched on it, but let's go into the math a little bit. So futures contracts are enormous. So if you have an S&P 500 contract, that is ES, you're looking at about $250,000 of exposure. So if you have a 1% move in that market in a day, which is not uncommon at all, you're going to make or lose $2,500 like that. Now, your micros are a tenth of the size as a standard contract. So it's the same market. It's the same moves on the charts. You just have a tenth of the exposure. It means you're going to make a tenth of the profit, but it means you are only going to lose a tenth as well, right? This is the environment that we learn in. It's real money. There's real risk. There are real consequences. There is real stress, but it's much more survivable, right? So instead of a $2,500 loss, maybe you take a $250 loss. Does that suck? Does it sting? Yeah. But like you can survive that a lot more than you can survive 2,500, right? And expect, even when you get good at this, you're gonna have trades that lose money. We are looking for consistency over time, and we are relying on exponential growth, or compounding interest, I guess is a better way to put it, right? So we're not looking for home run after home run after home run. We're looking at, does my profit and loss ratio consistently lean toward the profit, right? If we're doing this, we're good. If we're doing this, not so good, right? So these are some of the contracts that we're going to use. These are kind of the common ones. There's plenty of other ones, like oil is big. Silver, gold, platinum, copper, all of the crops that can be stored. So like not lettuce, but corn, grains, that kind of thing. So you have MES. So that is the S&P 500, and that is representing 500 of the top US companies. So your Apples and your Microsofts and all that stuff. MNQ, that's your mini NASDAQ, your micro NASDAQ. That's the 100 biggest tech companies. I trade MNQ a lot, but I think MES is better for learning. I'm not going to go much further into it than that. There's just it's a little bit slower with MES, which is a good thing as you're learning. NASDAQ, it's more volatile. So you can make more, but you also have a higher risk and a higher likelihood of having bad trades as you're new and you're learning. And because it's the 100 biggest tech companies, and they basically follow like what am I semiconductors. There's a lot of volatility, right? It's a lot of speculation. So that's why it has more moves. And then you have the micro Dow Jones. That's 30 of the big ass American companies, your Coca-Colas, your Disney's, your whatever's. And then you have the micro Russell, M2K. That's your 2,000 smaller companies. So MES, MYM, M2K move slower than your NASDAQ. Just something to think about. Okay. We've got that kind of figured out. We kind of understand what the futures market is. So let's look at a chart. I promise you this is going to be so much simpler than snapshots of a chart you've seen where you're like, okay, I have no idea. So this is a chart. The chart literally is just two axes. It typically is laid out like this. It's not going to be in these colors. I have another video up where I walk you through the trading view interface and how to navigate it and stuff, which you should really go look at. You should really take the time to set that up with me in that video, because I will tell you, I would not recommend trying to learn a trading platform or charting platform while also trying to learn all this stuff without any support. I did, and it was rough. It took like 3 months to be able to confidently navigate TradingView when I was just trying to figure it out. And there's a reason I go with these colors, and just go watch that other video. It's really important, and it's going to help set you up to be able to navigate this stuff. But anyway, a chart is just two axes. You have time running across the bottom, and you have price running up the side. That's all. You can move your price over to the left side if you want to. I look over on the right side, right? I'll look back historically at the left side, but whatever's happening here, that's where your current price is. That's it. Everything else is dressing. You have your candles, and then you start putting indicators on there. You put all this other shit on there, but it's literally just two axes. Let me see. Do I go into it? Okay, no. So we're not going to read a chart yet. You know what? Yeah, let's read a chart. I want to show you how simple this is to read, because right now you're probably like, what the fuck, dude? I don't know. So with these two axes, this tells us something, right? So let's say at 10 o'clock from whatever the screenshot was, I want you to tell me what price was or did at 10 o'clock. You can do that. I promise you can do that. It's like, okay, well, it's 10 o'clock. You go up this candle here, this green candle. This is the one we're talking about. So we'll talk about the anatomy of a candle in a minute, but we can just say, if you're like, all right, cool. So this little stick coming off of that green one, that looks like it comes down to about, let's call it 29,973.50 or something, 74. Okay, cool. So it went from there, and then look at the top of this stick, the same thing. We come over here, doodly doodly doo. It was about 29,988. So now we know at 2,200, that was the price range that occurred over this time period. You just read a chart, and then you can do that with this one, and this one, and this one, and this one, and that's it. That's all it is. Obviously, it's more nuanced than that, but essentially, like you just read a chart. So a line chart, I know you've seen one of these. If you ever watch the news, you're going to see a line chart. Line charts are okay. I would not recommend using them. I wouldn't recommend using them. Each one of these dots here that you see represents price at a point in time, which is cool. That's right. Like, we want to know that. What it doesn't do is show us what price did over that time period. So if, these look like there was a 20, so these looks like they're 5 minute, it's a 5 minute chart. Each one of these dots represents 5 minutes. It doesn't show us what price did over that 5 minutes. And this is probably like the end of that 5 minutes. We call the close of that candle, or, whatever, of this time period. So all we really see is 5 minutes ago, price was here. Now it's here. Now it's here. Now it's here. So these lines don't actually show us how price got there. It's just like from one to the next, right? It's just connect the dots. We are missing so much data that we really need to make intelligent decisions about our trades. We need the candles. So this is, they have extra stuff. A line chart is only going to show you one price per slice of time. A candle shows you 4. You have your open, your high, your low, and your close. And you'll see here in a second, this gives us so much more information. It's the same information that is being applied to these different types of charts, but you're going to get a lot more of that visible to you, excuse me, with the candle charts. So you're going to see how price got to where it got, not just where it is. And then once you get used to the candles, which should be pretty quick, like I promise you're going to never want to use line charts again, because you're like, dude, I need this other information. Cool. And you're going to learn how to read these so quickly. It's not going to be an issue. So this is the single most important thing other than our 2 axes on the chart. Everything else is extra. And I'm doing this. This is the principles first thing, right? We're starting at the very foundation and we're building, and we're going to just keep doing that. We're going to keep doing that. We'll come back and we'll revisit something in more detail, but that's just higher fidelity of something we already are learning about. So let's jump into this. Like I said, we got these 4 different prices on a candle. You've got your open, your high, your low, and your close. So I'll just let you know now, this teal color is a candle that goes up in price. The purple candle is a candle that goes down in price over that slice of time. When you first open up an account, whether it's whether it's TradingView or something else, almost always going to default to a candle that goes up in price is like a bright green, and a candle that goes down in price is a bright red. I do not like that. I am trying to help make this as analytical and non-emotional as possible. So there's so much research, and it's so well understood that colors affect our mood. So if you have these bright, vibrant colors, you're going to have stronger responses, right? So if you see green, you're like, oh, good. Green's good. Green's the color of money. Yeah, good. And you see a red candle and you're like, oh, that's bad. Red's bad. It adds a lot of emotion that we can kind of get out of things so we can be analytical. So even this is brighter than I use on my charts. Like you've seen my charts already. It's like the pastel colors. It gives you less of a signal to react to emotionally when you see it. And that's an important thing. So please, seriously, go watch another video and I'll set you up and I'll go further into that and everything. So, okay, let's talk about this box. Oh, you actually got to put this back on. So this box here, this is what we call the body of the candle. Being that this is a green candle and price moved up through this time slice, the bottom of this body is where the chart open, or this candle open on whatever chart we're on, whether it's 5 minute, 10 minute, an hour, whatever. It opened here. And at the end of that slice of time, it closed here before starting the next candle. So this is the price this is the range that price moved from over that slice of time. So that tells us one thing, right? It tells us just open and close. The wicks, you'll hear people kind of just be like, nah, they're not that important. No, they're like super, super important. You'll hear stuff like, oh, do I include the wicks in my this, that, or whatever? Yes, for God's sake. Yes, absolutely. Don't listen to anybody that says they're not important. They, a lot of the time, can be more important than the body. And these little sticks, we call them wicks, right? The wicks of a candle. Sometimes you will have one on each side. Sometimes you will have one on only one side. Sometimes you won't have any at all. Sometimes they'll be really long. Sometimes they'll be really short in relation to this candle body. We'll get to all that. And I don't need you to memorize like this is a doji and this is a falling star and this is Thor's hammer. And you don't, who cares? That's just memorizing patterns. That's not what we're doing. We're going to read it. So the important thing with these wicks is what they're telling us. They're telling us the story of what happened over this slice of time. So this lower wick, this bottom of that wick is the lowest that price got to over this slice of time. So if we think about it, if you can visualize what happened, where you have buyers that are looking to buy and you have sellers that are looking to sell. And there's just this constant battle between them to find a winner, essentially. So as we're doing this, price is going up, people are buying, people are selling, and then there are more sellers for a little while that overpower the buyers. So it pushes price down. And then the buyers come back and they're like, no, actually, we want to buy some more stuff. And they push stuff up and they overwhelm the sellers and they overwhelm the sellers. And it's doing this through, it's moving around over this slice of time. And then at some point it pushes up, buyers push it up to here, and then sellers get stronger and they're like, all right, yeah, we'll sell. And they push price back down here. And then this time period closed. That's it. When you read a candle, that's what you're looking at. We are going to go so much further down the rabbit hole on how these interactions play out, what they actually mean. And we're going to strip all this down to that fundamental level. But this is the bedrock. So we can get into that. This stupid thing out of the way here. Okay. All right. So like I said, a green candle means price went up. So it started at the lower part of the body. It had price movement down here. It had price movement up to here, and it settled out and closed up here. This is what we call a bullish candle. This is what we're talking about when we say we went long. We're in a long position. I'm holding through a bullish candle because I expect price to go up. So the other side of that is red or purple or magenta or whatever color you want it to be. Because price is going down, this is a candle that is going down. The opening price is the opposite of here. Price started here. It did some stuff up here and it was pushed down. Price came down to here at close. This is called bearish. This is called a short position. So I got really tongue-tied on bullish versus bearish. Both start with B. They're both the same amount of syllables. They're both animals. I hate bears. Bears scare the absolute shit out of me. I don't like them. I don't like watching them on TV. I don't like seeing them in real life. I don't like bears. So I thought about it as like, boo, down with bears, right? Like bears can go to hell. That's how I remembered in the beginning that price moving down, it's bearish. Your bullish is moving up, right? That's a little bit of that vocabulary that we'll start using. I was in a short position on a bearish run, bearish candles, and I closed at whatever price. Yeah, you know what? I went in a long position on this bullish candle, bullish series of candles, this bullish run, and I closed my position at X price. Right? I kind of already talked about this. So what does that wick really show? How far price went beyond those ranges of the open and close. Yeah, we already explained this. Price went there, didn't stay there. Yeah, it got pushed back. So, yep, I explained this already. Yep, I already explained all this. Okay. So this isn't me saying, hey, I want you to memorize this pattern. We're not going to do that. We're not doing that. That is you just copying and memorizing without understanding. So, first principles, we're going to understand what these are doing. So you got 5 candles. Let's say each one of them is 5 minutes. And when you look at them in their totality, it tells you kind of a story, right? So let's look at this first one. So there's 1, 2, let me grab my little thing. 1, 2, 3, 4, 5. So candle 1, bullish or bearish, up or down. So this is a bullish candle. It went up. Price started here. It ended here. And then we had these long wicks that show where price went during this 5-minute slice of time. Price came down to this level from sellers selling, and then buyers overwhelmed them, pushed them back up, pushed them all the way up here, and then the sellers came back in strong, and they overwhelmed the buyers and pushed price back down to here. Then the next candle, bearish or bullish? Bearish, down with those fucking bears, send them to hell. Price started here, it closed there, or opened here, closed there, and then it moved back and forth, right? It moved outside to these extremes. So price got pushed all the way, we'll say probably kind of came down here, pushed back up, buyers came in to here, and then sellers overwhelmed and pushed them all the way back down here. They pushed them a little bit past with some momentum maybe, and then the buyers stepped back in and they pushed price back up here and it closed. Third candle, bullish or bearish? Bullish, right? Opens here, closes here. You had fights on either ends or on both ends. Price was pushed down to here. So maybe it was like here, it came up a little bit, it got pushed down to here, and then the buyers stepped back in with more pressure and overwhelmed the sellers. Pushed all the way up here. Sellers stepped back in at this price range and overwhelmed the buyers, and price pushed it back down here and price closed here. Fourth candle, bullish or bearish? It's bullish, but not by much. Open, close. This is called a doji. That doesn't matter. Who fucking cares? It's what it tells you that matters. What you have is a lot of effort based on these wicks. There was a lot of contested area on price. Very little movement. So this was basically equal pressure both directions, right? And then what do we have? Bullish or bearish? Bearish. Big bearish body. Big wick. No wick at the bottom. So what does this story tell you? Price opened here, price closed here, it made it up here at some point. So we open, we move down. Somewhere buyers step in really strong and they push price, push price, push price, push price up here. The sellers step back in and then they drive price all the way down to here where the candle closes without any overshoot. We will dive so much further into this where pretty soon you will anticipate that you will understand exactly why this happened. And this happened. Like this story is going to make so much sense to you before long. And I think you're going to be really surprised at how much this right here will actually tell you and how much you can anticipate based on what knowledge you're going to have. But we're starting to bedrock. We've already had some vocabulary come in here, but let's talk a little bit more. Kind of the important ones, you're long, you're short, your position, your fill, and your stop. We already kind of talked about the long position. Price is going up. So if you go into a long position, you are putting in a position in the market saying, I believe that price is going to go up and I am putting money where my mouth is. So if price goes up, you sell it and you make money on that spread, right? $5 a bushel to $5.50 a bushel. You said, I think it's going to go up to $5.50. It goes up to $5.50. You sell it, you make your money. A short position is the opposite. That's you saying, I think price is going to go down to $4.50 a bushel from $5. I'm going to put money on that. And when price moves down to $4.50, you buy. You close your position. You get that spread. You get that 50 cents. So the position is just where you are in, like going in live into the market with a trade. So cool, I'm long one on MNQ. What does that mean? I just bought one MNQ contract expecting price to go up. And MNQ is NASDAQ, micro NASDAQ. So that is what that means. Then your fill is when that trade goes live. You can do that as I'm going to buy it right now, or like I am going to put in an order so that when price hits this place, it will trigger a fill. So that's saying I know price is going to get to blah, blah, blah. Or I believe the price is going to get to blah, 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 blah. I am going to have something executed there. In this case, a fill order. So, yep, my fill came in at $29,967. And then a stop order is the opposite of your fill order. You're in a position and you're saying when price hits this, you either do it manually or you set it with like a stop loss or something. As soon as price touches this line, close that position. As a stop loss, that is you saying, this is the maximum amount of risk I am willing to accept for this position that I'm in. If it goes down to my stop, and we'll get into that, and like where to place them, how to place them, why we're placing them, I am deciding that my read of the market was not correct, at least within the parameters that I need it to be. So it will automatically stop that trade. So if you're in a buy position, it'll sell. If you're in a sell position, it'll buy to get you out. And that prevents you from having price run away on you and you blowing a whole account because you got up to go to the bathroom and there was some big news that came through or something. So then you have your bid, your ask, and your spread. So your bid is the highest price somebody's willing to buy something at right now. So this is at an auction, which is an analogy that I'm going to use to be able to explain the market stuff and the price action, everything like that. So you're at an auction and it goes to the highest bidder, right? So you're saying, I am willing to buy it at this price right now. And then the ask is what somebody is willing to sell it at. Like, okay, well, I want this much for it. I'll sell it to you right now if you give me this much. I'm asking you to give me this much for it. And the spread is the gap between those two things. And it's usually very small. So as an example, the bid comes in, hey, I am willing to buy this thing at $29,967. And the closest person who is asking, who is saying, I will sell it to somebody, is willing to sell it at $29,967.25. That is a 25-cent spread. So if, say, I want to buy that right now, I don't want to wait for price to come to me. I will have to say, okay, fine, I'll pay $29,967.25. It's 25 cents more than I wanted to pay, but I want that right now. And then the same on the flip side. I really want to sell this. Fine, I'll come down to you and I will sell it to you for $29,967, which is 25 cents less than I wanted for it. So that spread, as small as it is the cost of crossing that spread to get your order filled. That is somebody saying, buy now, sell now. That is not somebody who has a market order in of when price reaches here, then do X. So to make that clear, if nobody was ever willing to cross the spread to meet somebody else, the market would be a flat line. If everybody waited for price to come to them, there would be no market. The market and the price movement is predicated on people who want to buy right now, want to sell right now, want to get into a position right now, want to get out of a position right now. Somebody has to cross the spread. That will make a lot more sense later. It will be very, very important later. So just understand that that's how that has to work. Somebody has to be willing to take action right now while somebody else is saying, I can wait. So then timeframes are the next important thing to be cognizant of. I've been calling them like slices, but if you say, I am on a 1-minute chart, what that is saying is I have the time frame set that each candle represents that slice of time. It's a 1 minute slice that it is representing, those 4 points. Or it's a 5-minute candle. Or I'm sorry, a 5-minute chart, or a 15-minute chart, or a 1 hour chart, or a 4 hour chart, or a 1 day chart. If you just say I'm on a 4 hour, people are going to know what that means. So it's all the same chart, which I'll get into more. It's different time frames, which means that it's a different view of the same data, which also means that it's different participants in the market. You can't have Granny buying 20 kilos of Coke from the cartel. Doesn't work. You need her buying her yarn, and you need the drug dealers buying their Coke. Drug dealer, kingpin, isn't going to be shopping for yarn. It'd be weird. He wouldn't fit in. He wouldn't be welcome at that market, right? So as day traders, small account retail traders, we are going to be using as little as the 1 minute chart. I don't like that. I'll explain why later. A 5-minute chart or 15-minute chart or an hour chart is kind of what we're using. And then your higher time frames, your 4 hours, your day, your week. Week's a little extreme, but it depends on what you're doing. Those are your contextual charts. So you're saying on a macro scale, what's happening, what has been happening, what does it look like is going to happen. And then you go to your smaller time frame, your different market that you have access to. And then you are trading in that environment within the context of the bigger environment. All of these things will be elaborated on. So how does this thing actually work? If I click buy or I click sell, what's actually happening? So you don't buy the chart. The chart is just the thing you're looking at. You are buying a contract, a futures contract. So the chart is just that, it's the tape, right? It's the receipt. It's just showing you what price, by its very nature, again, we'll get into this, you're seeing lagging information of what's already transpired. You have your order book, which is showing you current, which we'll get into. So each contract is going to have a different size based on the symbol that you're trading. So if you're trading MES, which is micro S&P, that is $5 per point of exposure. So if it moves 2 points, that's $10, one way or the other. MNQ, which is micro NASDAQ, that exposure is only $2 per point. And then you have, like, say, MYM, right? Dow Jones, 50 cents per point. So if you look at that right there, you get 2 point movement for MES is $10. For MNQ, it's $4. For MYM, it's $1. So you would go, oh, well, I'm just going to trade MES. That's the most money. It is also the most money you can lose per point, because your risk scales with your profit potential. But that's not quite that simple. That's not quite how it works, because different charts, like I said, different symbols have different personalities. So yes, you make more per point with MES, but it is not as volatile. And that's why I think it's a really good one to start with as you're learning, because it's slower. It's a little, I wouldn't say more predictable, but you have more time to make decisions. And it's not going to move so dramatically that you get knocked out of position and you get kind of like, I don't quite know how that happened. You still will. You will do that plenty. I still do that. Where I'm like, what the fuck was that about? I'm like, how did it happen? But if you look at something like MNQ, which I like to trade, it is a lot more volatile. So even at $2 per point, where, say, the MES chart is going to show a price movement of, say, 300 points, maybe MNQ will move 1,300 points. So, oops, oh my gosh, I'm sorry, I'm sure that was very loud. It just kind of depends. Well, it depends on a lot of things. But anyway, the other thing is, when you want to make more money, you don't need to move more points. You need to have more contracts per position. So if I'm like, all right, cool. 20 points. I got $100 when I had a 20-point move. I want to make $200, so I need a 40-point move. No. You need to consistently be able to hit the 20-point move, or whatever it is, right? You just say, okay, I'm going to do 2 contracts. So I'm going to have $10 of risk exposure for the potential for $10 of profit per point now. So now that 20 points gets you $200. You didn't have to go further. You do the same trade. You just add more contracts. And contracts you have to buy as a whole number, because you can't buy part of a contract the way you can buy, part of a share, or a share is a part of the stock of Apple, right? So just keep that in mind. So when I click buy or sell, when I go long or short, when I think things are going to go bullish or bearish, this is how it goes. So if we're going to go long, we say, I think price is going to go up. I'm going to trade that direction. You're going to buy at, say, 29,967. That's a cool number. We're using a lot. And then price goes up. Like, oh, hell yeah. All right. So now we sell when price hits 30,017. That is a profit of $100 per contract. This is the classic buy low, sell high. This is the thing people are most familiar with and most comfortable with. Price going down does not mean it's bad. It's not good for us if we're in a long position and price goes short, but if we are anticipating it and we say, I actually think price is going to go down, I think it's going to go bearish, I think that I'm going to get into a short position. So we say, okay, cool. I'm actually going to sell at 29,967. And I'm going to wait until price gets to 29,917, and then I'm going to buy, which gets you out of your position. Whatever the opposite is of what got you into the position will get you out of the position. So now you've still profited $100, because remember, we're trading that spread, the difference here. So this $100, we pocket that. So this is sell high, buy it back when it's lower. This is the thing that is really cool about futures, and that you can do it with one currency instead of having to have multiple. Okay. We're going to cover a lot more of that later too. So if we look at P&L, profit and loss is important. It is not the end all be all. It's just a data point. So I don't want to get too caught up in this, because the thing that is going to make you successful is consistency over time in your practice of what you're doing, and how you get it, how you read the charts, how you make decisions, how you get in and out of position. That's going to be a lot more important than, did I make money or did I lose money? Because if you are consistently performing and executing well, the money will come. It's a byproduct that cannot be avoided. If you're consistently performing well, the money will come to you. If you're hyper focused on the money and the P&L, and oh my gosh, well, I only made this versus this, and my profit to loss ratio is this to this, you're focused on the wrong thing. You're focused on the back end. You're focused on not the first principle, which is understanding everything and making your decisions correct. And then the other things happen. So, all right. So how does this work? You got your $29,967 on that M&Q contract that you bought, expecting price to go up. Price does go up 50 points to 30,017. You sell it. And remember, M&Q is worth $2 per point. So 50 points times $2 per point gives you $100 profit. MES, $5 a point. M&Q, 2. MYM, 50, right? We've already gone through these. And I just want to reiterate, the way we make these numbers bigger is not 100 points up. It's 2 contracts. It's 5 contracts. It's 10 contracts. And when you're at 10 contracts and you're consistently trading at 10 contracts, maybe then it makes sense to move up to the regular market. You don't have to, but maybe it makes sense. But we'll get into that as well later on why it actually might make sense to stay in the micros for a lot longer, if not indefinitely. This right here is why we're starting small, because if this went against you, you lose $100. All right. You got a couple $1,000 account. That sucks. If it's $200, that's your maximum exposure. or your maximum loss for the day at 2%. So, but this is why we do this instead of this being $1,000 up or down. So when we're starting something new, you need stuff, but you don't need all the stuff, right? If you decide that you want to start fishing, you're like, I'm going to start fly fishing. And you immediately go out and like, I have ADHD. So, I mean, undiagnosed, we're pretty sure, you know? So I have had so many projects that I start and I spend thousands of dollars on, and then I'm like, I'm bored, you know, I go walk away from it. And in reality, I only need a couple of things. So let's say you want to learn how to fly fish. You're like, I've been watching YouTube videos and I've been going down this rabbit hole, and like, okay, well, first thing is I need a boat, but I don't know shit about boats. I don't know shit about backing trailers. So I need to get a boat. I need to figure out that thing. That's going to cost a bunch. And then I don't know anything about outboard engines. So I'm going to have to learn how motors work and how to service them and do all this, that, and the other. And then, oh yeah. And then I also am I'm going to have to pay and spend my time doing the certification to become a licensed captain so I can drive my boat. And then, okay, well, now I need to figure out where I can go fishing. So now I need to like do all this research on that and see what the best water is and where to go. And oh my gosh, well then now I need the fishing pole. And okay, well, what do I need? And what reel do I need? And what line do I need? And what tippet do I need? And you know what? I want to tie my own flies. So I need to get the whole setup for how to tie flies and all said and done. You're like, fuck, you haven't even gotten a lure wet. What do you really need? A fishing pole and some lures. The rest of that you can get later. I say that because it is very, very tempting. And you're going to do it. And I'm going to say, don't do that. And you're going to go, what do you fucking know? I'm going to go do it. And then you're going to do it. And then you're going to come back and be like, just wasted a bunch of time trying to figure out how to service a Mercury outboard when I really should have just been reading the fucking chart or fishing, right? I should have been learning my cast. So you are going to go pick up a bunch of indicators and a bunch of other stuff because you're going to get frustrated and you're not going to understand things because you're brand fucking new at it and you're not being nice to yourself. Be nice to yourself. And you're going to wind up with all this dressing, all this extra shit that you don't need, that you don't understand, that doesn't actually help you because it's a crutch. And then hopefully you don't give up and you come back and you go, all right, fine. I'll learn the fundamentals. Okay. You need 3 things. You need a broker. You don't even need that right now. So a broker is just, it acts as a bank, right? So having a broker is what allows us to do our transactions and especially allows us to make money on a short position. So you put money in, you put $1,000 in, and it's like a little bank account, right? You put the money in, they guarantee it. And then when you go to click buy or sell, they process that. They fund that. When you're selling, you're essentially taking out a little loan from your broker. Go, yeah, we'll cover that. We'll cover that $10. As long as you have it in your account, we'll cover that. I guarantee that money goes to you. So as long as you have enough money in your account to make that trade, you have enough margin, you can make the trade, you can sell. You can sell something you don't technically own, right? There's a lot of stuff out there. I mean, like here's just 3 examples: Schwab, IBKR, NinjaTrader. I use NinjaTrader. They have some of the lowest fees, and they have very high fill rates, which we'll get into later. There are plenty. Pick what you like. Shop around. Make some free accounts. But you don't really need that right now. So we can actually kind of call it 2 things that you really need. You need a platform. This is where the buy and sell button go. This connects to your broker. This could be directly from your broker. So again, I use NinjaTrader. I can do all my charting in there as well. I choose not to because I don't like the interface as much, but you can find combos, but you need a platform. Somewhere where you can press buy and sell. And then you need your charting. And the charting can be the same as your platform, or it can be different. So I use TradingView. A lot of people do, a lot of people don't. I think it's the cleanest. It directly interfaces through like an API probably to my broker. So I have the ability to do all of my charting and all of my trading in the same place. That works for me. It doesn't have to work for you. play with stuff. Some people are totally happy having even totally separate, where like they don't have an integrated broker that connects to TradingView. So what they would have to do is they say, okay, on this screen, I have TradingView, and this is where I'm looking at my charts, and it's very clean, and I like it, and I know this interface and how to use it. And then over here, I have my insert whatever for NinjaTrader that doesn't connect to TradingView over here. So I'm looking here, I'm making my decisions, and then I come over here and I click buy or sell. That works if you want to do it. I just like it's clean, having everything together. The only non-negotiable for a platform or a charting interface, it has to have paper trading. Most of them, you can make a free account and you get paper trading. That lets you go into the real market and play with monopoly money. Is it the same as trading with real money? No, absolutely not. You're going to be really surprised the first time you go live at how much of the mental game you didn't realize was left out, and the emotional response that you're going to have to real money, even if it's like nothing to you. You're trading a $5 position. You know, you have a stop loss at $10 or whatever, and you're like, oh, I'm going to try to make $20. It's going to trip you up. It's going to fuck you up, and then you'll really. It's important that you do that at some point in the next like 3 months or something. Do a little test run, but not right now. We're not doing anything with real money right now. I want you to just get in there and just start getting comfortable with your interface, comfortable with the program and the software, and comfortable analyzing the market and putting trades in. Because you're going to fat finger shit, and you're going to make mistakes, and you're going to click buy when you meant to hit sell, and you're going to forget to set a stop loss, or you know what I mean? Like you're going to make mistakes. Do it with fake money. It's going to hurt a lot less. Here we go. Non-negotiable. Fake money, real platform, same chart, same price, same buttons, same simulated balance. I will say with caveat that if you use something like TradingView, that can it can do a lot of things, different types of markets. It is not going to be a perfect replica of how the actual trading goes. So, like with NinjaTrader, let's just say with a paper trading account, the way the buying and the selling and setting limits works is not the same as when you have a live account linked to your broker. That fucked me up at first, and I lost some money, not a ton, but I lost some money while I tried to figure out like, oh God, okay, like how do I actually do this? So just be aware of that. You need to learn stuff. You need to get comfortable without the emotional weight of actually losing money. You're going to make a lot of mistakes. You will act differently under pressure of the live market with live money. That's the reality of it. Expect that, but we're going to try to train some of that out of you. Okay. I actually don't even want you to do this for weeks. I want you to do this for months. I don't want you opening. I mean, you can put money into a brokerage or whatever, but I don't want you to be putting your real money into the real market for at least 3 months. I know that seems like a long time. It's not. You're going to get in there and you're going to lose that money. I almost positive, almost guarantee that you are going to lose all of your money in that first account. Know that. Don't let that turn you off. Don't think you're so amazing that you're going to just take off and make millions and millions of dollars. I mean, you might. I don't know. But, think about it as an education. If you go to college and you want to get a degree, you want to get an education on something to hopefully make money later, you're going to pay for it. That is your tuition. It costs money to learn stuff to make money. This is no different. It's just self-paced. And there are no tests. There's nobody. I mean, I'm going to try to help guide you, but ultimately this isn't an individual sport, right? So if you think about, I'm going to put $500 into an account. It's a very small account. It's basically the smallest you can go to be able to fund an account. And I'm going to trade MYM or M2K at like 50 cents a point. Okay. That buys you a lot of mistakes. You can make a lot of mistakes that way. expect to lose money. Expect that $500, that $1,000, whatever that you've put in there as tuition is going to be spent. And that's okay. And that's good. And you need that. And you're going to learn a ton about yourself. You're going to learn a ton about how the markets work. But do not do that for 3 months. Please, please, please. And then when you go in, it's going to be stressful. You're probably going to lose money, but it's going to be so much better spent than if you're trying to learn all of the tiny beginner rules right out the gate. That's a lot of stuff. I talk a lot. So before we go on to the next thing, before you start the actual courses that I'm putting out for you, remember to be nice to yourself, please. Like, be nice to yourself. This is really hard. This is really hard. There's a reason that, like, a legitimate statistic of 99% of people are not successful traders. There's a reason for it. It's probably because they're not getting good help. They're getting a bunch of bullshit off the internet where everybody's contradicting each other and their egos are in the way and they want to name this system after themselves or that indicator or whatever. And it's fucking hard. And if you're not feeling encouraged and you just feel like you're getting beat up all the time, it makes sense to want to leave. You are smart. This takes time. There's a reason not everybody does this. Be nice to yourself. Be patient. Please be patient. You wouldn't expect to pick up a violin for the first time ever in your life and be playing Mozart by the end of the day. Like, that would be a ridiculous thing to assume. Being profitable your first day or your first month or potentially your first year, that's not going to happen. You're not playing Mozart, right? You're going to be learning hot cross buns for a couple of weeks. And that's fine. And that's progress. And it's cumulative, right? So please, please be nice to yourself. Most people are going to quit early because they expect too much of themselves. Don't be that person. This is not a get rich quick thing. Anybody selling you a get rich quick trading thing is selling you bullshit. This is a skill like anything else. This is a new language you're learning. It's a new instrument you're learning. This should be a long game. This is compounding interest. This is going to be hopefully a lifestyle for you. And hopefully before too long, this becomes a life-changing amount of money. You can make a life-changing amount of money on 100 points a week. It's going to take a while, but you'll get there. It's the same way a 401k works, right? Because your percentage increases, which means your risk tolerance increases, not because you feel more tolerant of the risk, but because the account will tolerate it. And that continues to grow. As long as you are consistent and you are not trading off vibes and feels and shit, you're understanding things fundamentally and you're making decisions off of that. Please be nice to yourself. Don't compare yourself to anybody else. These internet gurus or somebody showing you this awesome fucking trade they made. It's probably not real. Or it's real, but you're not seeing all the bad traits they have. Right? You can't compare yourself to somebody else's Instagram life. If you are able to hang tight through the next few months, make it through these modules, you're already in such a better place than anybody. And I promise you, by the time you're done with all of them, or like 3 of them, you are going to understand more about the market than like anybody you know. I promise you. You may not have all the stupid jargon because you don't fucking need it. Because you'll actually know what's going on and you don't have to try to impress people because you actually know what's going on. So I think you are ready for the next one. So let's think about the things that you didn't know an hour and a half ago that you now know. You now can tell me what a market is. You can now tell me what a futures market is, or futures trading is, what a futures contract is, what it represents, why it happens, what a candle is, the 4 different price points on a candle, what those mean, what going into a trade in a long position or a short position means, the things that you need to start, and how to start moving toward, I won't even say profitability, a deep well of understanding that you can capitalize on later. All of this stuff, I think you'd be very, very hard pressed to find out in the wild. As far as the foundational basic understanding of starting to learn this language without Google searching a bunch of shit. You're still going to. It's part of the learning process. But I think you're going to be ready to jump into Module 1 and all of the foundational stuff that it assumes you already know. So I'm really proud of you. Thanks for sticking it out. I know I'm a talker. I am going to stick with you. Like I said, if you already watched the other modules, feel free to watch them again. I'm going to record them with better audio. Okay. Love you. Bye.